We're unpacking a massive, literally multi-billion-dollar clash happening in the markets right now. Seriously, you've got to ask yourself, what actually happens when cold, flawless AI algorithms look at the exact same market data as legendary Wall Street billionaires, and they come up with completely opposite game plans? On one side, we've got machine learning models screaming at us to buy the tech dip. On the other side, some of the most successful human investors in history are stockpiling cash and buying up gold like it's the end of an era. Today, we're putting these two perspectives head-to-head to figure out exactly what's happening, why it matters to your portfolio, and how to navigate this massive divide. Okay, let's dive right in. Here's our roadmap for today. We're looking at current market sentiment, how AI is picking tech, the defensive moves by Wall Street whales, the sudden resurgence in value stocks, hidden market risks, and finally, an actionable playbook to wrap it all up. Section 1. Today's market sentiment, the current financial chessboard. So before we figure out who's buying what, we kind of need to look at the board itself. Recently, we've seen a mixed to positive market, largely thanks to inflation data that came in milder than people feared. But under the surface, a major rotation is happening. And this brilliantly illustrates exactly what that rotation looks like. Look at the divergence over just 5 days. Energy is up 3.2%, financials up 1.8%, both flashing super bullish signals. But then look down at the bottom half. Consumer discretionary, tech, communication, all in the red, pulling back over 1% each and triggering bearish signals. Tech is actually seeing a very selective pullback right now. It's like traditional value and energy are suddenly sprinting, while high-flying tech just needs to catch its breath. Moving to Section 2, AI algorithms pick tech, specifically the Daniel Finn perspective. So if tech is pulling back, are the purely data-driven AI models getting spooked? Well, no way. Absolutely not. Dan Alfin's AI system ranks stocks from 1 to 10. And get this, it is totally ignoring the recent tech dip. It's handing out perfect 10 out of 10 scores to the undisputed heavyweights of AI semiconductors, NVIDIA, Broadcom, and TSMC. The algorithms aren't seeing a bearish trend at all. They're seeing a massive, flashing neon sign to buy AI infrastructure. They're even handing 9s to big tech players with deep AI moats like Meta, Google, and Amazon. The machines are basically yelling at us to stay on offense. And you know what? The algorithms aren't exactly alone here. Billionaire investor David Tepper over at Appaloosa Management is fully on board with the machines. His whole thesis is that AI infrastructure spending remains incredibly robust and big tech earnings are super resilient. And he didn't just say it. He put serious money where his mouth is. He just bumped up his NVIDIA position by a massive 15%, added 12% to Meta, and 8% to Broadcom. He clearly believes the hyperscalers are going to keep spending billions. Section 3. Whales make defensive moves. The contrarian pivot. So this brings up a massive, absolutely crucial question. If the AI is so sure and guys like Tepper are doubling down on offense, why in the world are some of the other legendary super investors suddenly retreating? I mean, what did they see that the algorithms are just missing? $325 billion. Let that number sink in for a second. That is Warren Buffett's current cash pile at Berkshire Hathaway, a literal record high. And how do you get there? By systematically dumping his massive Apple position, slicing it by another 10% recently. Now, he's not running from the market out of panic. He's just exercising extreme, ruthless valuation discipline. Sure, he's parking a little bit in energy like Occidental and Chevron to hedge against inflation, but mostly, he is sitting on a mountain of cash, just waiting. Now, what's really fascinating here is this stark contrast. On one hand, you've got Tepper playing pure offense, doubling down on AI. But then you look at Ray Dalio from Bridgewater, and he's basically building a financial doomsday bunker. Dalio is making these massive defensive plays. He just bumped his position in the gold miners ETF, GDX, by 22%. That was his single biggest move. He also loaded up on 20-year treasury bonds, adding 18% to TLT, and even started a brand new position in ConocoPhillips. Dalio's whole thesis right now is diversification into gold and oil to hedge against fiscal and monetary uncertainty. So while Tepper buys the tech future, Dalio is buying the instability hedge. All right, Section 4, the values stock resurgence. This is where algorithms and whales actually agree. You might think this market is totally split, but there is actually a middle ground. The Grok AI recently ran an analysis hunting for the most undervalued stocks globally, focusing on low price to earnings and price to book ratios. And guess what? The supercomputers actually love a good bargain bin. On the NASDAQ, it's finding tech names with super depressed multiples. Down in Australia, it's flagging resource and financial plays trading below book value. In Hong Kong, it's pointing at Chinese tech and property stocks sitting at multi-year lows. And in the Dow, it likes industrial and healthcare laggards. All of a sudden, those boring, cheap companies are looking pretty fantastic. And the super investors are validating this AI value screen in real time. Take Seth Klarman, absolute value investing legend. He is aggressively rotating into financials right now. He just hiked his stake in Wells Fargo by an insane 25% and Citigroup by 20%. His reasoning? Financials are deeply undervalued, and these banks are primed to benefit from a rising rate environment. And it lines up perfectly with the Dentalfin AI, which just bumped JP Morgan, Bank of America, and Goldman Sachs up to a solid 7 out of 10 score. The smart money and the smart tech both love a bargain right now. Section 5. Hidden Market Risks. The Macro Storm Clouds. Okay, before you pull up your brokerage app and start copying these trades, let's zoom out. Because both the AI and the billionaires are staring down some pretty nasty macro threats. So the crucial point here is that any one of these 5 catalysts could literally flip the market narrative overnight. Number 1, a Middle East escalation could easily send oil flying past $100 a barrel, sparking a major stagflation scare. Number 2, a Fed policy error, like delaying rate cuts, leading to a sudden growth scare. Number 3, China's stimulus just straight up failing, which would crash global commodity demand. Number 4, earnings revision risks, where companies lower their Q3 guidance. And number 5, this is a big one, AI CapEx digestion. Like, what if the hyperscalers suddenly slow down their chip orders? All that perfection priced into NVIDIA and Broadcom would just evaporate. These are the risks keeping the defensive whales up at night. Section 6, the actionable playbook, synthesizing the data. Let's move to how this all builds into our final playbook. Synthesizing everything we just looked at, here's where the convergence is. On the overweight side, we want to align with both Tepper and the Dalio AI on AI semiconductors. We also want some exposure to Hong Kong value stocks and financials, riding that wave with Seth Klarman. But for defense, we follow Dalio and Buffett, overweighting gold miners and energy. On the flip side, we want to be underweight on consumer discretionary, since it's already flashing bearish signals. And to protect the portfolio, the data suggests hedging, using put spreads on overextended tech, or if you're sophisticated like Ken Griffin, trading volatility. But listen, maybe the absolute most important part of this entire playbook is the cash reserve. The data is heavily suggesting keeping 15 to 20% portfolio liquidity right now as your dry powder. Mirroring Warren Buffett's current strategy doesn't mean you're giving up on the market. It means you're exercising extreme valuation discipline. When one of those 5 hidden risks triggers a sudden drawdown, that cash reserve is exactly what lets you swoop in and buy the panic, rather than being a victim of it. So that brings us to our final thought for this explainer. In a market that is quite literally split right down the middle between the relentless optimism of AI algorithms and the record-breaking caution of human billionaires, what's your move? Are you playing offense or are you playing defense? The data's all on the table. It's totally up to you to decide which side of history you want your portfolio to be on. Thanks for hanging out with me for this explainer, and keep learning.
All information provided is for educational purposes only. Always consult with a qualified financial advisor before making any investment decisions.
Thank you for watching. Please like and subscribe to our channel.